Thanks for joining us again. We're joined now by Hambro and Olivia Markham of the BlackRock World Mining Trust. Obviously, the mining sector has elements of cyclicality to it, and we've had a very strong performance run in the last 10 to 12 months. But there's also a lot of commentary out there from people like Goldman Sachs that this could be a multi-year cycle with a lot further to go. So Evie and Olivia have a lot of experience across multiple cycles within the sector. I'm going to hand over to them now. They're going to talk us through how they see the sector, the broader world, how the portfolio is positioned. Just before I do, there's a wee quick reminder for everyone. There's a Q&A function available. So if you want to submit any questions you have throughout, we'll try and address those towards the end. A lot of people on the call today, so we might not have time to get through them all, but we'll try and come back on any we don't have time to at a later date. So I'll pass over to Olivia and Evie. Thanks.
Thanks, Callum, and thank you all for dialing in today. It's a huge pleasure to be able to talk about the trust. Just as a kind of a heads up, we are about to announce our results, so we can't stray into too much detail with regards to the kind of any final news for the calendar year or financial year of 2020. But we look forward to talking in this presentation about the general outlook. So the first thing I'm going to do is actually hand over to Olivia to go through the first half of the presentation, and then I'll come back in and do the second half, including the performance of the trust, underlying holdings, and a bit of outlook. Thank you.
Great, thanks very much, Evie, and thank you everyone who's joined the call today. We've obviously had a very strong performance across the mining sector in 2020, and we continue to expect to see another really solid year for metal demand this year. Economic activity has picked up very strongly post-COVID. You can very much see that if you put the top chart there, which just shows the PMI index in China. Overall, we've seen governments issue a significant amount of debt. They're starting to refocus on infrastructure programs again. We've also seen pick up in this overall construction activity, which really sets a fantastic backdrop for the sector. China has obviously recovered post-COVID very well, but what's really surprised us has been the pickup in recovery that we're now seeing in the US and Europe. So when we put all of this together, we see we have very much a strong year again for metals demand this year. Just move on to the next slide. Just to give you a bit of a snapshot in terms of some of the key commodities that were invested in the trust and how they performed last year. So you can see here a very, very strong performance in the iron ore market, really driven by the ramp up in steel production in China. Copper, exceptional performance from the lows in March. This is a very big exposure for us in the portfolio today, and a clear winner for some of the green stimulus programs that we've seen announced over the last 6 months. Gold, very much a year of two halves, very strong performance during the first 6 months of last year, has remained largely range bound during the second half of this year, and we've tried to play that quite effectively in the trust. And then just lastly on oil, the reason I show it here is, despite the fact we are starting to see the oil price move up, it's still at a relatively moderate level, which is, as a result, not seeing a significant amount of cost inflation come through across the industry. And then the last thing I kind of wanted to leave you in before I go into the outlook for this year is just to give people a bit of a perspective as to where we actually are in the mining cycle. So what we've done here in these two charts is that we've looked at the performance of the equities on the left and the copper price on the right compared to other cycles that we've seen in the past. And if you have a look at the current cycle, which is the maroon line, you can see it appears to be very, very reflective of the cycle that we saw in the late 90s, coming out of the GFC, and also from the lows in the sector from 2016. I think the important point to make here is that when we look at these cycles, they tend to be around 3 years in duration. So I think we are very much still at the first innings here. And as we look at the outlook for this year, which I'll spend some time on, I think there's a number of reasons to suggest that we've still got further to go in the space. So if we then start to focus more on, in terms of the key drivers for the sector for this year and over the medium term, there's really 4 factors that we're really focusing on. The first one is improved capital allocation and refocusing on shareholder returns that we've seen really over the last sort of 5 to 7 years now. And as a result of this underinvestment, there's actually very little new supply coming into the markets over the next couple of years. So it's a really interesting juncture where we have demand picking up as a result of all the stimulus programs, but at the same time we have very little supply to meet that. The other important point to make here is that, whilst COVID saw a big shock to demand last year, it also saw a big shock to supply. And you can see on the chart on the right-hand side that we actually saw a number of the commodities see, supply impacted during the course of the year. And as a result, we're now in this period where we're entering a pickup of improving demand, yet we have actually very low levels of inventories, with a number of the commodity markets in deficit today and expected to be in a bigger deficit by the end of the year. The best example here, which we can see on the next slide, is if we look at copper. So as you can see, just like looking at the chart on the right-hand side, which shows you global copper inventories, these have been steadily dropping over time. And if you actually have a look on a sort of an inventory on a days of usage basis, we're expected to, as we move into the second half of this year, get to really quite critical levels of inventories, which is suggestive of prices continuing to move higher. Now, the interesting thing when we look at copper is it's not just being current supply that's being impacted, but we've actually seen, as a result of COVID, a number of the growth projects have also been delayed. So whilst we've said we have very little supply coming into the market, this has actually been exacerbated even further from some of the things that we've seen around the delays due to COVID. So we then move on from underinvestment. The next sort of key factor that we're looking at is this really quite rare period where we're seeing synchronized global infrastructure spend in China, the US, and Europe. And there's really only been sort of two notable times when this has happened, which has been post-GFC and also in the late 90s. So when you look at these environments, it's incredibly supportive for commodity demand. And the point that I also make on this infrastructure spending is it very much has a green angle to it. So this is important in terms of the commodities that we want to get exposure to. We've talked about copper, but some of the other kind of battery-related materials are also benefiting from this environment. The next factor that people are starting to talk more and more about is the prospect in inflation. We are seeing inflation expectations pick up, and this is very much being reflected in the long end of the curve. But I do think that we are in for a period of higher inflation. The Fed has been quite explicit in the way that they're willing to tolerate higher periods of inflation. And also we have a very low rate environment, which is also conducive to having higher inflation come back into the system as well. Now, as I'm sure many of you are aware, commodities provide a good hedge against inflation, or a good protection against inflation. And as you have a look at the next slide, you can see very clearly the performance of some of the commodities in absolute terms in periods where we've had higher inflation. So what we've done here is we've done a study which looks at periods in time since the late 90s when inflation expectations have picked up. And in those periods of times when inflation expectations have picked up, you can see, if you have a look at that chart in the middle of the slide, the performance of the commodity. So if I take here the example of copper, on a 6-month period, 12-month period, and 2-year period post that pickup in inflation. And as you can see, very, very strong moves in the price of the commodities in response to that. We have already had some of the benefit of this come through. The copper price has already moved up strongly since inflation expectations picked up last year, but I think we've still very much got further to run, and we're certainly seeing a lot of interest come back for commodities in general, but also for the equities, given the prospect of higher inflation. And then the last point that I just wanted to spend a little bit more time on is the new, well, it's almost an acceleration of some of the longer term themes in terms of metal demand. And this is really on the very, very significant investment that we're going to see globally around decarbonisation. Now, people often say that COVID has been the accelerator of many of the trends and themes in the markets today, and this has been very much the case in terms of decarbonisation. We've seen over the last 6 months a number of governments commit to a goal of net zero emissions by mid-century, and notably we've seen China do this. Now, this is going to take very, very significant amounts of investment to achieve this, and we do see a number of the commodities as being clear beneficiaries of this. Copper is the clearest probably example in terms of what we're looking to get exposure in the trust, but also some of the battery materials are obviously a very strong play on this as well. So we very much want to sort of start talking about the mining sector and almost changing some of the narrative around this, because if for a world that is very focused in terms of achieving decarbonisation, the mining sector is absolutely critical in order to achieve this. I won't spend too much time going through the details of slide 12, but really what this is showing you here is the improvement in copper demand over the medium, and then it actually accelerates into the longer term as more and more investment goes into areas such as wind, solar, electric vehicles, etc. So if we just move on to the final section, final point, sorry, which is obviously there's a lot of positive drivers for the space, but it would be unjust of me not to also speak about some of the risks. We've seen during the course of this year that there has been some obviously nervousness around COVID second waves, and essentially the sector and the commodities in general have sold off a little bit during the second half of January as people have been nervous around the impact of COVID and how it could impact the overall economic recovery. I think as we're starting to see the vaccine rollout occur very well in this country, and it's going to follow through to the rest of the world, I think a lot of these risks will diminish as we move into the remainder of the year. One of the key risks for the sector over the last couple of years has been worsening trade tensions between the US and China. Obviously, this is still very much a focus point, but if anything, I think it's moving on to other sectors than just on the mining sector as we look forward over the next couple of years. And then one risk that people often ask us about, and actually it's not something that I'm particularly concerned with at the moment, is that we actually see the mining executive and mining companies go back to some of the poor behaviour that we've seen in the past around capital allocation. Just going through the result seasons this year, it's been fantastic in terms of the dividends that have been announced by the companies. They've all exceeded expectations on this front. And from all of the engagement that we've had, very much still focused on maximising shareholder value and sticking to the new capital allocation priorities that they laid out a couple of years ago. If we just move on to the final piece. Actually, I think I'll pass back to Evie to speak a little bit more on the companies and the valuations.
Thanks, Liv. And as you can expect, we are very, very optimistic about the outlook from here. I think Olivia has been through a number of the key cases why we see such the risk is so kind of skewed towards upside across the space right now, given the imbalances between supply and demand and how they're likely to evolve over the next few years. What we find confusing is just how this is not yet playing out in terms of valuations. So the first one we wanted to highlight is that when you normally go through an economic crisis, the mining sector is one which tends to capture some of the worst performance during those periods. But one of the reasons why that didn't transpire in 2020 was the very strong balance sheets that the companies have built up over the last kind of 5 or 6 years. We've seen aggressive debt repayment as the companies have kind of harvested cash flows during that period and been disciplined in terms of not allocating, free cash flow into growth projects, which again kind of comes back to the point Olivia made about the supply side constraints. But having this very strong balance sheet is a characteristic that the sector really hasn't had, for decades. And it's obviously one of the key reasons why last year's performance was so much better than you would normally expect during a period of economic downturn. When we move on to the valuations themselves, the sector continues to trade below long-term averages. When you look at PE multiples, you look at price to book, you look at EV to EBITDA, etc., all of the metrics you might want to look at, they are trading substantially below where they have been in the past. And this really is the conundrum. You have a resources sector that's less risky today than it has been in the past because it's carrying less debt. It has a brighter prospect than it's had for many years, yet the valuations continue to trade at these discounted levels. And when it comes to income, we're seeing, very, very high levels of income generation across the space. And thankfully, this is now being paid back to investors. The headlines are constant. We're just going through the earnings season at the moment. And we're seeing these enormous levels of dividends coming back. Ordinary dividends, special dividends, dividends being rebased. you know, the move to a formulaic payout in terms of payout ratios that was done several years ago remains in place today. And so you can imagine, as these businesses are generating the margins that they're enjoying today, the reduced claims on that cash flow through low levels of capital expenditure and no requirement to pay down debt, because that's basically behind them in most cases, you know, the option remains just to hand the money back. And that's what we're seeing. And we think that, well, we both think and we hope that this dividend resilience and the high yields will act as a catalyst to trigger a rotation of capital out of areas where people have normally gone for income that have been much more kind of badly impacted during the last year's downturn. You know, the huge 75% cuts we saw across the energy space, you know, the end of dividends in the financial sector, the damage being done in tourism, leisure and travel. And also in today's you know, increased emphasis on ESG, the unattractiveness of tobacco-related dividends and other sources that don't meet those kind of ESG tests. I think it's increasingly likely that people will look to the resources sector. And now, as the newspapers reported just recently, BHP is the biggest company in the UK market by market cap. So it's hard to avoid in terms of the sector's significance. Coming on to the trust itself, one of the things we like to point out is that the trust is designed to capture, you know, performance from the sector through the cycle and deliver a superior return. And when we define the superior return, that is a total return, so a combination of income and capital growth. You can see the long-term dividend history for the trust going back to the IPO on the 15th of December 1993. And you can see where we really started to step up our focus on income, which was just about 10 years ago. We've been able to do this for a number of reasons. The tools available to us in an investment trust allow us to maximize that income through a whole variety of investments that we can make outside of just owning the underlying equities in the companies. So things like fixed income securities, options trading, direct investment in commodities, and our royalty positions are also positive contributors with regards to diversification of our income mix, which we'll touch on in a second. The other element is obviously the high level of payout that the board has decided to adopt. So the policy from the board is to pay out substantially all of the income generated during the year. And obviously we're on the cusp of announcing our results, so we can't tell you what that final dividend is likely to be. But we have when you look at the income NAV, which is published on a daily basis, it does give shareholders a lot of transparency on what that payment could end up being. When we also think about the mix of income, this is where we feel we're adding quite a lot of additional value. You can see on the left-hand side of this page the amount of money that comes from ordinary dividends. And you can see that the majority, roughly half of our income mix, comes from this source. But you can also see the high level of volatility in that area versus some of the others. And so you can see the example in 2016 where ordinary dividends shrank substantially and then obviously recovered very rapidly. Whereas you look at the fixed income payments or the option premiums that we're able to generate, there's a much greater degree of stability there in terms of its overall contribution to the trust's revenue line and therefore earnings and obviously flow through to dividends. 2019 was a big year for special dividends. 2020 was a year of more cautiousness as companies obviously battled through the pandemic and decided to favor caution over continuing to make the large payouts. But we've already seen the headlines in 2021 with large special dividends already being announced by a number of our holdings. And we would expect that trend to continue looking forward from here. The growth in our income from royalty sources is a combination of the existing royalty in Brazil on our copper and gold mine there continuing to pay out, but also the addition of a higher level of exposure to iron ore related royalty payments from Vale, which have added quite a lot of growth in that part of the market. And we would hope to be able to continue to grow our royalty payments in terms of our overall income mix over the next few years. Coming on to the discount on the trust, we're actually very pleased to see the discount narrowing. I think people are starting to recognize the high growth that we're seeing in the underlying sector, plus the potential for these very high rates of income coming out. We've seen quite a lot of change in the shareholder register as institutions have dropped, and a much higher level of ownership by retail investors. And that really has driven that increase in demand. And this is obviously a huge positive with regards to the reputation of the trust, to see that discount narrow in significantly and actually move to a premium over the last few weeks. In terms of our largest holdings, you can see this on the left-hand side of the page. This was as at the end of January. One thing just to highlight, you've got two holdings here with asterisks against them, Vale and Oz Minerals. Both of those include the underlying ordinary shares, as well as also royalty-related instruments to give that combined exposure. And then the rest of the list is fairly self-explanatory in terms of some well-known names. There have been some changes to this list during the year, some quite considerable ones in terms of the positioning, in terms of moving our commodity exposures up and down, but also the inclusion of new names as the stories of those companies have evolved, and the attractiveness from a value potential for us has put the companies back onto our radar, and we've built positions back up in some of those names that weren't there 6 months ago. In terms of performance, you can see here the long-term performance of the trust. You can see that 2020, the share price was up just under 50%. The NAV was up about 31%, and our reference index was up about 20% over 2020 as a whole. You can also see in 2021 the performance has continued for January, and we obviously would hope that the story of long-term capital growth and ongoing high dividends continues, given the underlying success that the companies are having in the portfolio as a whole. So just lastly, in terms of summary and outlook before we move to questions, I think just to recap a little bit on what Olivia has said, 2020 was obviously a year of significant disruption with regards to the pandemic, but many of the trends that we saw in place pre the outbreak of the virus have actually been accelerated in terms of thinking about the future. Whether it's the things that we've all become used to doing, like working from home and operating virtually, whether it's the deliveries of food that we're now enjoying, all of that stuff, that shift in kind of lifestyle is playing out in one direction, but also it's the shifts to a lower carbon economy globally. And the thing that I'm exceptionally excited about is the fact that we do have this kind of multi-trillion-dollar plan for expenditure, which is very green orientated. It means that the growth in GDP will be much more commodity intensive for the world as a whole than it has been for many years over the last kind of couple of decades, really going back to the China related bull market of the first decade of this century. We also have to remember that that period of time was driven exclusively by China. China represented over 100% of demand growth for commodities during that period of time, with the rest of the world, flat to lower in terms of commodities consumption. So now we're faced with this kind of coordinated spending that's green focused, it's going to be commodity intensive, and we've had a supply side that's underinvested now for many years. And that does mean that we have this imbalance between supply and demand that should be very supportive for commodity prices. With companies continuing to maintain capital discipline, it's likely that with the low levels of debt, that the payments back to shareholders will continue to be at a very, very attractive rate. The yield premium that the sector trades on today is starting to become noticed by generalist investors, and that could trigger a rotation back into this space. And then lastly, I just wanted to talk about some of the other areas of exposure in the portfolio. We do have exposure directly to commodities that are benefiting from this trend around sustainability. The exposure to commodities like lithium, cobalt, rare earths and so on, and copper in particularly. These commodities are likely to see much higher rates of demand growth as those metals are used extensively in this transition into a lower carbon economy. And that, again, is over and above the expenditure that we're likely to see in terms of getting the world back on track in terms of that fiscal spending. So thank you very much for that, and obviously we'll move forward into questions, Callum.
Thanks very much, guys. We've got quite a lot of questions coming in. Please keep them coming. I don't know if we'll have time to get through all of them, but we will hope. I think we're going to try and address them afterwards. Copper is obviously a big theme within it, and we've seen a couple of questions coming up on that. Any comments around the potential use of, reuse of scrap copper, recycling of copper, or of greater efficiency in it? And also, in terms of supply, how much is it? How much of the existing or supply that's likely to come on board again is this in like shallow, easy to access open pits against sort of more expensive, harder pits?
Yeah, I mean, I think there's lots of ways we could answer this question, and I'll leave it to Olivia to talk about the kind of demand potential and things. But one of the things that we have been very focused on in the trust is this concept of what we call urban mining, so effectively recycling. And this is an area of significant debate and focus for us for a number of reasons. I think if you're a company that's producing electric vehicles today, you want to know where your commodities are coming from that you're putting into those vehicles. You want to know the carbon footprint of the production process. And if you can achieve a more sustainable source of production in those commodities with a low level of carbon intensity per unit of production, then you are likely to pay premiums for those commodities relative to alternative sources. And we are starting to see this come through. So it's been interesting to follow the announcements from a number of our companies in our portfolio who are signing up to things like the Copper Mark, which gives that transparency on production processes, whether it's the steel companies that are now starting to produce and sell green steel at a premium to market prices for ordinary steel. Now, this is an area of the market that's going to evolve very rapidly. I think the increased transparency, maybe the involvement of blockchain to identify commodities as they go through the supply pipeline, just understanding the footprint of the good that you're consuming, how it's been generated, the production processes behind it, the source of the materials, all of that is going to be integral into a consumption decision. And I think the resources sector has got a lot of potential to really capture dollars that are kind of left on the table in this area as people think more about this as an area of focus. But I'll hand to Olivia in terms of talking about the overall picture for copper itself.
It's a very it's sort of spot on in terms of how we're thinking about the copper market. So if we have a look at it from a demand perspective, and I'd still say we're pretty early days on this. We see the potential over, say, the next 5 years of anywhere between 500,000 or 700,000 tonnes of additional demand as a result of these kind of green-related spending, be it in electric vehicles or from also greater use of wind and solar and the grid investment that will be necessary alongside that. I think longer term, this has the potential to move significantly higher than that. So just to put that into numbers that people maybe understand a little bit better, this has got the potential to add sort of 2 to 3-4% to annual demand. Now, when we think about matching that onto what's happening on the supply side, there is actually, as I mentioned earlier, around as a result of underinvestment, very little new supply hitting this market. And the other point that's worth also noting on future supply is it's becoming increasingly more challenging to bring new supply into the market. There's much greater regulations on the need for own water sources in areas such as Chile. A lot of companies are investing in terms of having renewable power, and there's just a constant issue the sector faces in terms of grade decline at existing operations. So, we do see over the course of this year the copper market being in a deficit, but actually this could be prolonged for a period of time, particularly if we start to see further acceleration from a demand perspective.
You've touched obviously on supply and demand there. I've got a few questions coming in about CapEx discipline and whether or not this is a sort of broad-based thing or if this is really just in the majors who are the marginal drivers of it and what's to stop them now that it looks more attractive to go on an M&A spree or whatever. And in that context, I think it might be quite good to sort of touch on the dividend as well, because obviously this dividend is being funded out of free cash flow, which is a lot of cost and supply discipline on their part. Now, how sustainable? What sort of margin of error for the dividends should they go and look to expand their capacity a bit by some cheap M&A, for example?
Yeah, I think there's multiple ways of answering that question, Captain. I think the first thing is obviously the resources sector. Going back 10 years ago or so, was, had a terrible track record with regards to return on capital. And there was huge change in management teams. There were massive write-offs of assets that had been over-invested in with too high a capital intensity or M&A. Assets were bought at the wrong price. And this really damaged the credibility of the sector in terms of investability at a time when the focus of the market was moving away from traditional businesses into technology and elsewhere. And so it couldn't compete for capital. So there had to be change. And as a result, the companies have gone through that process. They've paid off the debt. They've been through the downturn in terms of economic demand, growth for commodities. They've increased efficiency and productivity from existing assets and maximized the potential out of the investments that they made in the previous cycle. And so the sector today is kind of, in most cases, governed by much tighter levels of capital discipline and improved operating practices, both from a sustainability, health and safety, but also returns focus. And then the kind of last element of this is the shift in dividend policy. Most companies have moved to low levels of balance sheet gearing and payout ratios linked to free cash flow or earnings. And they've honored those promises now for many years. And so the kind of track record is starting to build up where people can believe once again in the potential for the sector. So that kind of the long process of re-earning investor trust, we are quite a long way into that. We definitely haven't completed the journey, because otherwise the valuations would be much higher than where they are today. And people would be paying premiums for these shares. So I think that's all still ahead of us. But we as an investor team are much more comfortable talking about this because of the track record that the companies have built up and the fact that management teams remain so disciplined. The last point I'd make is around transparency. The market now is so much more transparent in terms of investment decisions. Companies, when they come out and do transactions or make capital investment decisions, are almost required to disclose the return expectations. Long gone are the days where it was, trust me, this meets my hurdle rate of return. We now have a much clearer understanding of why an investment decision is being made. And so company and management teams and boards of directors can be held to account around those decisions. And I think that on its own is also holding back some of the temptation just to go and build something for the sake of growth. So this kind of value over volume strategy that's been in place now for 5 or 6 years is really driving that improvement in credibility on this metric. So we will see investment decisions into growth, but we don't see that as a huge risk in the near term.
I'm going to try and combine a couple of questions I've seen in. Seen a few coming in about gold. Unsurprisingly, it's a fair weight in the trust, but also been quite divergent from industrials. But I just think it'll also be quite useful to get into whether or not you hold physical or you prefer just to maintain solely to the mining companies, and what kind of operational gearing the mining companies, maybe across the metals, have to higher spot prices, and how resilient they are. One person's made the point that all the gold companies have, as you say, as an industry, have displayed good discipline. Their all-in sustaining costs are much lower than the current price, and yet they still sell off with a much higher beta to gold into any decline in spot. So how do you manage portfolio risk from that perspective as well?
Yeah, I'll touch on a couple of those. So in terms of the allocation between gold and the equities, we can own physical gold via ETFs in the trust, and we do that during periods of time. We've done that during the course of last year. Today, all of our exposure is in the equities. As I mentioned earlier in the presentation, we had reduced our gold exposure during the second half of last year, which is really a reflection of the very high and very strong performance that we've seen in gold as a commodity, but also in the gold equities during the first half of the year. And then also our expectation that we would start to see a pickup in just overall industrial activities and our view that the industrial commodities, copper, iron ore, etc., would perform better in that environment. In terms of the point around sort of leverage and gearing to prices, I think there's a couple of points to make around this. I think the first is we have seen, and this is across the gold companies, but also the industrial commodity companies, is that we have seen a significant amount of debt being paid off down over the last couple of years. So, that financial gearing that we have to commodity prices is lower than what there is in the past. And also the fact that we're now seeing margins expand as companies have done a very good job in reducing costs. We would also expect to see some of that more operational gearing come down as well. But in saying that, we still have positive gearing to the commodity price. So it doesn't surprise me that when the commodity price goes up, that the equities will outperform, and the same happens on the downside as well. But the magnitude, i.e. the sort of the beta of the move, is a lot less than what we've seen in the past, just because balance sheets are stronger and margins are much more resilient as well.
And just on the, we're trying a lot of things in, but just when you sort of see the spot coming off, are you willing to look through that as an opportunity, perhaps to add to like a well-managed business? The share price is overreacting to movements in spot which don't particularly affect the operational performance.
Yeah, absolutely. When we think about our investment philosophy and how we are valuing companies, we're very much focused on the kind of the medium to longer term outlook for these companies. And at times you can see dislocations between value and price when you see over exaggerated moves on particular news items or commodity events, and if warranted, then we will obviously take advantage of that.
We had a question come in on rhodium that was so quick, I think they must have copied and pasted it beforehand, having it ready to go. Just on the, how far the spot price of rhodium can go, which has obviously been a phenomenal performer. But I think it also ties into a broader interesting thing, which is that rhodium is so rare that it's almost always a byproduct. I don't know of any case where it's not. A lot of these sort of industrial metals like silver, for example, is ordinarily a byproduct. How, if you have a sort of constructive, positive view for the sort of supply-demand curve and these more industrial metals, or any of the really more rarer ones, how do you play that within, how do you tilt the portfolio to take exposure to that? Do you tilt more towards diversified that just simply have a larger concentration of that, or do you look for explicit plays?
I think it's the rhodium has been the most incredible performance, but it's I think for those who what's that movie Avatar, they were trying to mine unobtainium there, and there are right now some of these commodities do feel very, very scarce. And people are paying premiums for getting access to them, and we're already really at the start of what looks to be a very long cycle of high levels of capital investment around the world, which are going to be commodity intensive. So, I think most commodities are going to benefit from the kind of the tide as it comes in. The demand tide is going to lift them all, and some more than others. With regards to rhodium and the other platinum group metals, our exposure to those is held via predominantly are the companies we own in South Africa, which are the world's largest producers of those commodities. Those companies have been through the most incredible change, a similar story to the broader mining sector in terms of repairing balance sheets and so on. But they've also been very aggressive in diversifying their businesses internationally. Buying assets in North America has been a key source of that change. So they've consolidated the industry position, they've diversified their production base, changed their cost profile, paid off their debt, and they're now obviously benefiting from this, these great moves in terms of the kind of what they refer to as the basket price. So the mixture of platinum, palladium, rhodium, ruthenium, etc., that they produce that occurs naturally in those ore bodies. And so that's how we built exposure in that area. Rare earths is another one, a key commodity mix, which is incredibly hard to find in the equity markets because China controls most of the world's supply, but we've got some fabulous exposure to rare earths production outside of China, and also some kind of inherent long dated value in the portfolio with a company that could be going into rare earths production in the near term. And so when you start to think about that, there are these kind of hidden exposures, I suppose, in the portfolio that do drive some great returns. But it's key. The key thing is to make sure that our own portfolio is sufficiently diversified that we're not relying on one particular commodity or one particular theme to drive the overall return. Otherwise, the volatility of the outcome is going to be higher than most of our shareholders would want.
We've had a few questions in about China, including on the supply side as well, but also I think more predominantly from the demand side. So sort of how reliant do you see the global demand picture as being on Chinese demand? And also, I mean, the Chinese yuan's been quite strong in recent months, maybe for a different variety of factors. But just how much of like recent months sort of restocking that's maybe helped, global demand, do you think that might just be strategic stocking, and how do you see that as a potential headwind or tailwind as it goes?
So if you have a look at demand for commodities today, you'll see that China is the overwhelming source of demand. It tends to represent more than 50% of demand for most commodities, barring oil. Demand has been very solid over the course of this year and in the back end of last year. But actually, as we start to look forward for the remainder of the year, it looks set to remain very strong as well. And the reason that we have confidence over this is if you look back at the stimulus announcements and infrastructure projects that were announced in the back end of last year, and that there is a lag between when those announcements are made to when the actual investment occurs, and that is occurring right now. So we're in this period where physical demand for commodities is strongly picking up in China, and this is seasonally the strong period of demand for China over sort of the next 3 to 6 months or so. So it looks very solid. As I mentioned earlier, the area though that has really surprised us positively has been the pace at which the US and Europe has recovered. We thought actually that may take a bit longer, and it's exceeded our expectations. So yes, China is still the dominant consumer of commodities, but the US and Europe combined is also not insignificant. And the fact that it's starting to re-accelerate, what we think actually is really quite positive for the overall commodity demand mix as kind of a think of it in totality.
Great. Couple of other ones. Again, I'm going in a couple of things here. It comes back to the supply cost discipline and also cost risks. Now, one of the questions was around how you manage FX risk within the portfolio yourself, given relative strength of sterling, but also like to tie that into sort of, South African platinum group miners, for example. How do they manage currency risk? How much of that is hedged out, relatively stable? And the same applies to energy costs, which have obviously gone quite drastically different directions over the last month. How stable are actually energy costs to production costs?
So on currencies, this is a relatively easy one to think about. We look at our portfolio based on where the underlying assets are, rather than necessarily where the companies are listed, as a kind of first starting point, because that gives us a better insight into the risk. Because if the government changes the tax rate and so on, then that's a huge impact in terms of the profitability of the business. In terms of the currency mix, it's key to understand that all commodities are sold in dollars. And so the revenue lines of these businesses are effectively dollars. The exposure to currency is really mostly labor, depending upon where the businesses are located. And then within that, depending upon what type of operation it is, it might have a highly mechanized production process and labor is a low part of the overall cost. Or it could be a very labor-intensive underground operation where labor is a much higher part of that cost. And so when we think about our portfolio, we try and look at it, starting off from the point of view of dollars, because the revenue line is dollars. Then we look at the currency exposure based upon the operations, and we think what are currencies likely to do. And we try to run a diversified portfolio by geography to give us natural inbuilt hedging. What we've tended to find is trying to put currency hedging into the portfolio is very expensive, and it's quite high risk, because you're basically making a bet on the currency exposures themselves, and that can end up being a significant drag in terms of overall portfolio returns. So it's much more cost effective for us to do it through diversification rather than trying to put in some kind of clever derivatives contracts. In terms of the companies themselves, it varies. The 1990s was filled with companies who were hedging. And it was a disastrous decision for most groups, locking in prices that just generated additional supply of the commodity and caused prices to compress further. Most companies today are unhedged in terms of the revenue line. There are a few that still have some hedging, but that tends to be related to either a high level of debt that the company has taken on through an expansion, and they need to be able to be sure to have the revenue line to pay that debt. But I would say most companies in our portfolio don't have hedging as a revenue hedging as a philosophy. They do lock in long-term power contracts, and as you would do for things like explosives as well. But they tend to be, 1 or 2 years, and then the prices would be adjusted. And the same with labor agreements. Sometimes a company might be lucky enough to sign a 2 or 3 year labor contract where there are fixed changes in costs related to the various different assumptions that they've made. So it varies by business and varies by company and also by culture, depending on where the company's located.
Well, we're at our time limit now. I'm under threat of pain if we don't sign off in time, given we've got a really busy schedule today. Just want to say thanks very much for your time again, guys. And I think we addressed most of the questions there, but we'll have a look through again and hopefully we'll address any that we didn't manage to get to. I think there should be some relatively recent research published on our site. Thanks again.
Thank you very much, Callum, and thank you everyone for dialing in.
Thanks.
Thank you.
Thanks. Bye.